You imagine why did I start this video with this simple clip initially? We just showed ice rolling down and it's getting bigger as and when the time spent increases and it keeps rolling down more. Now this concept is called as snowball, and whenever the snowballs keeps rolling down, it becomes bigger in stature, bigger in size as and when the time increases. Now the effect of snowball can be seen everywhere in the world. It can be seen in your life, it can be seen in the life of successful people, and most importantly, the concept of snowball applies in the form of investing. We'll talk about these concepts in detail in this video. Now, what is the snowball effect? The snowball effect starts with a very small snowball. As and when the snowball starts rolling down, it becomes bigger because it picks up more ice on its way and it increases the whole diameter and the whole radius of the size of the snowball. And that is what we understand by the concept of snowball. Now, snowball has a very important implication in the life of every successful people. No one becomes successful overnight. It is with time, with small successes, with small achievements, you become bigger in stature. Even grand investors like Warren Buffett started slow and they grew in stature step by step, and that is how he became what he is today. Now the concept of snowball applies to the world of investing. It actually itself is a form of investing whereby which you invest the money over a period of time and you build accumulate to a substantial form. Now the most important disclaimer here is that this concept requires a bit of time to be invested in the market. You cannot expect snowball to take effect over a matter of few months or few years. You have to be invested in the market over a period of time, and which is how the concept of snowball takes over, and the returns which you get are crazy. You get exponential return. I'll give you a brief example for that also. But let's start with understanding what is snowball investing. Now, before I talk about investing in snowball, you remember a famous quote by Albert Einstein. He said, "Compounding is the eighth wonder of the world." And that is the whole principle upon which the concept of snowball investing is based. Say if you start investing with a small amount of money and you pick up, say, dividend stocks. Now, every year the dividend which you receive from your investment, imagine you start reinvesting back in the market. Now, over a period of time, the reinvested dividends also starts earning dividend for you. Imagine the exponential return which you will fetch from that kind of investment, and which is what the concept of snowball investing is all about. Snowball investing basically tells you whatever money you invest in the market and whatever returns it generates in the market, put that money back in the market because that money will start getting returns for you over a period of time. And to top it off better, if you want to grow even bigger, start investing money in a systematic mode. Basically, start investing money over a period of time regularly, and it accumulates to a greater amount of money over a period of time. Now, if you are looking to go for, say, small snowball investing, following are some of the do's and don'ts. Basically, in the do section, we have pick up those companies which are stable and strong companies, and also pick up those companies which give you dividends regularly over a period of time. They are not just one-time dividend payers, they are paying dividends over a period of time because they'll be using dividends to reinvest in the market. So you would want dividends from the investments which you have made. The classic example for those kind of companies in Indian market would be BPCL, could be ITC, could be Coal India. One small disclaimer here, we are nowhere recommending you to invest in this. This is just for the sake of explanation and for example purpose. And what are the don'ts of snowball investing? Avoid short-term investing. Don't get into investing for a year or 2 years. Put it over a period of time for it to show the real effect it has on the value which you have invested in the market. And also avoid non-dividend paying companies, because you will get returns on the appreciation of the share value, but that the share value might come down, but dividends once received stays with you and you can reinvest that. So look out for the companies which pay dividend to you over a period of time. Let us understand the concept of snowball investing with the help of simple example. We'll be understanding two scenarios, and before understanding those scenarios, following are some of the assumptions which you are running. You are expecting 6% annual appreciation in the value of the stocks which you have invested. You are expecting 4% annual dividend yield, and you're expecting 5% in the growth of dividends. These are three assumptions which you are taking while explaining these scenarios. Now in the scenario 1, say you have invested rupees 10,000 in the market and you let it run for about 25 years. So for a period of 25 years, the compounding effect is taking place in the market. So what do you see at the end of 25 years? You are expecting a return of almost 1,40,000 in the form of dividends, and the share price also appreciates about 90,000 rupees. Isn't it great? It looks a very impressive return. Now let us understand scenario 2, and you'll understand how much bigger is the scenario 2. Say in the scenario 2, you again start with the investment of rupees 10,000. The only difference here is that you invest rupees 10,000 on monthly basis. Basically, month on month basis, you are investing rupees 10,000 in the market. So you are putting money on regular basis. So it becomes a SIP mode, and the compounding effect is even bigger here. Let us understand the returns which will be fetching at the end of 25 years. So the total dividend which you would have received at the end of 25 years is almost 1.4 crore rupees. Yes, you heard me right. You're going to get a dividend of almost 1.4 crore rupees, and the share value would appreciate by almost rupees 80 lakh. Can you imagine investing just rupees 10,000 on regular basis for 25 years? The value of dividend and the appreciation in the share value. So that is the power and magic of compounding. Remember the assumptions, we have taken very nominal growth rate and nominal returns. Some of the shares even grow faster, but even at the nominal rate, the returns which you're going to get are exponential by nature. Let us compare the two scenarios. In the scenario 1, you have invested rupees 10,000 for one-time basis, and you let the compounding effect run. The dividend which you receive is almost rupees 1,40,000, and the share value appreciates by 90,000 rupees, and you're almost getting a dividend of rupees 30,000 per year. Now in the second case, where you're investing rupees 10,000 on monthly basis for 25 years, so total investment which you would have made is almost rupees 30 lakh, and you will be receiving a dividend of nearly 1.4 crore rupees over a period of 25 years. And you will also get 80 lakh rupees in the form of appreciation in the value of shares. So both the scenarios have a great advantage on the returns which have been invested. But in case of second scenario, where you're investing 10,000 per month, at the end of 25 years, you're getting a dividend of really rupees 3 lakh on yearly basis. So that is how powerful the concept of snowball effect is. The more you invest over a period of time and you let it run, the snowball effect becomes bigger and bigger, because the amount of wealth which you're putting in the market has become much bigger, which is where the snowball also has become huge for you. So that is how the snowball effect takes place. Now, why does this happen? Now look at the graph which I'm showing on your screen right now. Now if you look at this graph, over a period of time, the amount of money which you receive in the form of dividend is also reinvested in the market, plus the returns which you generate also get added up, and it becomes exponential, and it almost grows exponentially towards upside. So I hope this video on snowball investing gave you a decent insight on what snowball investing is and how can it be used by investors over a period of time to accumulate greater wealth. You need to start very small, and you just follow the rule and discipline of trading and investing, and you keep reinvesting a dividend in the market. I'm telling you, you will retire rich, and you have a chance of retiring very early in your life and enjoy life as it comes. So that is it from us in this third video of our segment called as True Story. If you haven't watched the previous two videos, I urge you to watch them because they have got great response. People are actually appreciating what we have bring forth for them. I again thank you for your patient hearing. I'll again see you next videos where we talk about another concept of True Story. Thank you so much.